Level 1. The cash problem. You are 34 and you have £400,000 in a holdall under a bed in a rented flat. That sounds like the end of a story. It is the beginning of a different one, because right now that money is worthless to you in every way that matters. You cannot buy a house with it. You cannot put it in a bank. You cannot lease a car, book a holiday, pay a private school, or explain a single pound of it to anybody who asks. It is not wealth. It is evidence, stored in a bag, decaying in value every month you fail to solve it. And here is the thing almost nobody outside this world understands. The crime that made the money is usually the easy part. Getting caught for the crime is a risk. Getting caught for the money is close to a certainty if you do nothing, because money is the only part of the operation that has to keep existing afterwards. A shipment arrives and is gone. A fraud completes and closes. The cash sits there for the rest of your life needing an explanation. So you now have a second job, and it is harder than the first one, and nobody who admires the first one has ever thought about it. That is the lesson of level 1. You did not make £400,000. You made a £400,000 problem, and every level after this is you trying to solve it. Level 2. Placement. The first move is the most dangerous one in the whole structure, and it is the one that gets nearly everybody who gets caught. You have to get physical cash into the financial system. Once it is inside, it is numbers, and numbers can be moved. While it is paper, it can only be carried, and carrying it is how people are caught. And the system knows this. Every bank in every developed country runs reporting thresholds. Deposits above a set amount are reported automatically without discretion by a computer. So obviously you deposit under the threshold, except that is also reported. Deliberately breaking a sum into under-threshold pieces is its own separate offense. Structuring, and in many countries you can be convicted of it even if the underlying money was completely legitimate. People have lost their savings to that rule while committing no other crime at all. So the cash has to enter somewhere that receives cash lawfully and in volume, and the classic answer is a business. You want one with a plausible reason to take a lot of small payments that leave no independent record. Somewhere the true number and the reported number cannot be checked against each other by anybody outside. Nail bars, car washes, vending routes, tanning shops, small takeaways. A laundrette, which is where the word comes from, and it is not a metaphor, it is a description of what somebody actually did. You buy or back one. It takes real money in from real customers. It also reports revenue it never had, and the difference is your cash walking in through the front door with a receipt behind it. You are now paying tax on money you already had. That feels absurd the first time you do it. It is the price of the whole scheme, and everyone at this level pays it without complaint, because tax paid is the strongest evidence of legitimacy that exists. That is the lesson of level 2. The most exposed moment in laundering is not the spending. It is the first inch, the point where paper becomes a number and everything after it is comparatively safe. Level 3. Layering. The money is in. Now it has to stop being traceable to where it went in. This is the part that people imagine as the whole subject, and it is really just distance. Every transfer, every conversion, every jurisdiction crossed puts another step between the money and its origin, and every step costs an investigator time. You are not trying to make it impossible to follow. You are trying to make it expensive to follow, because investigative resources are finite and an expensive trail gets abandoned. So the money moves from the business account to a supplier, from the supplier to a consultancy, from the consultancy to a company in a jurisdiction that does not publish beneficial ownership. Loans are issued between companies you control, so a transfer looks like debt. Invoices are raised for services that were never performed. A marketing report, a licensing fee, a management charge, and the beauty of a service is that, unlike a container of goods, nobody can go and look at whether it existed. The most useful jurisdictions are not the ones on television. It is not palm trees. It is wherever a company can be formed quickly, cheaply, and with a nominee whose name is on the register instead of yours. And here is the part that surprises people. For years, some of the easiest places on earth to do that were not distant islands at all. They were ordinary, respectable, high-income countries with fast company formation and thin verification. Several of them have tightened it since, and several tightened it only after journalists demonstrated the problem publicly. And somewhere in the last decade, a new rail opened, and it did not do what either side expected. Cryptocurrency looked for about 2 years like the answer to this entire problem. It was not. A public blockchain is a permanent, complete, searchable record of every transaction that has ever occurred on it, which is the exact opposite of what a launderer wants. Hash is anonymous and leaves no ledger. A blockchain is pseudonymous and leaves nothing but ledger, forever, for anyone to read. So an entire industry now exists that does nothing but attach names to wallets, and it is very good at it. Sums have been traced years after the fact because the record does not decay and the analysis only gets better. What crypto actually changed is speed and reach. It moves value across borders in minutes without a correspondent bank, which matters enormously. But the hard step is unchanged, and it is the same hard step as always. At some point, it has to become money in a bank account with your name on it, and that point is an exchange, and the exchange asks for identification. That is the lesson of level 3. Layering is not clever. It is repetitive, administrative, and boring, and its only real product is the number of hours somebody would have to spend to unpick it. Level 4. Trade. Here is the largest channel of all, and it is the one nobody makes videos about because it is paperwork about shipping. The mechanism is a lie about a price. You export a container of something to a company you also control, and you write the invoice for far more or far less than the goods are worth. Under invoice, an export and value stays abroad. Over invoice and import and money leaves lawfully to pay for it. Either way, a bank has processed a payment against a document that looks entirely regular because it is entirely regular. The only false thing on it is a number that nobody can check. And nobody can check it because value is genuinely arguable. What is the correct price of a container of scrap metal, or secondhand clothing, or industrial diamonds, or frozen fish? There is a range, and inside that range a customs officer has no basis to object. Estimates of the sums moved this way run to hundreds of billions a year, and the honest answer is that nobody knows, because the method's whole nature is that it looks like ordinary commerce. Trade-based laundering is not a loophole in international trade. It is international trade with one figure adjusted. That is the lesson of level 4. The biggest pipe in this entire system is not a bank, a crypto exchange, or a shell company. It is a shipping invoice, and it is boring enough that it has stayed largely unexamined for decades. Level 5. Integration. The money comes back, and it comes back as something you can be seen to own. This is the point of everything before it. Integration means the funds re-enter your life as ordinary, explicable wealth, a salary from a company you control, a dividend, a property bought by a company, rented back to you, a gain on an asset you sold to yourself at a price you chose. Property is the favorite everywhere, and for a specific reason. A house absorbs a very large sum in a single transaction. It is expected to change value unpredictably, and once you own it, the money has become an address instead of a number. Art, at the very top, does something similar and more so. Value is genuinely a matter of opinion, so a price is very hard to call wrong. And now you can live. The car is leased by the company, the school fees are paid from a salary. The mortgage is real, the pay slips are real, and every document in your life would survive being looked at. That is the lesson of level 5. The goal was never to hide the money. It was to give the money a story that a bank, a tax office, and a neighbor would all accept without asking a second question. Level 6. The professional. You cannot do any of this yourself. Somewhere around here you stop being a criminal who moves money and become a client of people who move money for a living. And those people are not gangsters. They are qualified professionals with offices, letterheads, and regulatory bodies. An accountant who structures the companies. A solicitor whose client account can hold and pass funds with a confidentiality that a bank account does not have. A company formation agent. An estate agent who will complete a purchase without asking the question the rules say they should ask. Most of them are not sitting there thinking of themselves as launderers. The trade runs on a spectrum from open complicity through willful blindness to genuine ignorance, and the middle of that spectrum is where most of the volume lives. A professional who does not ask is more useful than one who conspires, and far harder to prosecute, because not asking is not obviously a crime. These people are the actual bottleneck of the entire industry. There is no shortage of criminals with money. There is a real shortage of qualified professionals willing to be incurious for a fee, which is why the fee is what it is. Commonly a percentage that would be outrageous for any legitimate service, and is simply the price of the only thing being sold, which is a signature. That is the lesson of level 6. The person who makes this possible has a professional qualification, a mortgage, and a complaints procedure. He is not hiding in the structure, he is the structure. Level 7. Scale. You are no longer laundering your own money, you are laundering other people's, and that is a completely different business. At this level, you are a service provider. You take a percentage, often somewhere between 5 and 20% depending on the difficulty and the volume, and in exchange the client's problem becomes your problem, and you have discovered the thing that makes this profitable. The infrastructure is fixed cost. The companies, the accounts, the professionals, the relationships are the same whether you move 1 million or 50. So every additional client is nearly pure margin, and the pressure is always to take on more, which means you now hold something dangerous. You know where a great many people's money came from and how it got clean and who signed what. You have also lost control of your own risk. Your exposure is now the sum of every client's exposure, and you did not choose their behavior. One of them will do something stupid. That is the lesson of level 7. The moment this became a business rather than a chore, your fate stopped depending on your own carefulness and started depending on the carefulness of people you have never met. And now, the part these videos skip. Everything so far has been the criminal's view, which is how this subject is almost always told. So it is worth being exact about where the money actually goes, because the answer is not car washes. The overwhelming majority of laundering by value does not run through nail bars and takeaways. It runs through regulated banks, large, famous, listed ones, and it has done for decades. The pattern is public, and it is repetitive. A major bank is found to have processed enormous sums for sanctioned states, cartels, or organized crime. There is an investigation, there is a settlement, usually measured in hundreds of millions or billions, and then the bank continues to operate, its license intact, with in most cases no individual senior executive convicted of anything. That has happened repeatedly at more than one institution, across more than one country, and the fines have been paid out of shareholder money rather than by any person. Meanwhile, the compliance system those same banks operate produces an enormous volume of suspicious activity reports every year, vastly more than any agency has the staff to read. Analysts describe the ratio openly. The reporting requirement has been satisfied. The reports are largely unread, and the effect of that combination falls somewhere specific. Banks manage their risk by closing accounts that look difficult rather than investigating them, which is called de-risking. The accounts that look difficult belong to money transfer businesses serving migrant communities, to charities working in conflict zones, and to whole small economies that depend on remittances. Those get cut off. The correspondent banking relationship of a large institution moving billions does not. So, the honest summary is uncomfortable. A system built to stop the movement of criminal money is very effective at inconveniencing poor people sending small amounts home, and has repeatedly failed to stop the movement of very large amounts through the institutions best placed to notice. That is not an argument that the rules are pointless. It is the reason the rules keep being rewritten, and the reason each rewrite is fought. Level 8. The State. Above a certain size, laundering stops being a crime problem and becomes a foreign policy one. At this level, the client is not a gang. It is people connected to a government, officials moving public money out, oligarchs moving private money that came from public assets, or a sanctioned state that needs to buy things in a currency it is not allowed to hold. The mechanics are the ones from level 3, executed with far better lawyers. The difference is who protects you. Below this level, your protection is that you are hard to find. Here, your protection is that finding you would be politically inconvenient for somebody with power. And the money at this level does something visible. It arrives in a handful of cities, always the ones with stable property law, good schools, and courts that respect ownership. And it buys property, sometimes at volumes large enough to move an entire housing market. People who have never met a criminal in their lives pay more in rent because of what happens at this level. That is the transmission mechanism nobody puts in the thumbnail. That is the lesson of level 8. The largest flows are not hidden from the state. They are frequently arranged by people who are part of one. Level 9. The exposure. Something surfaces. Almost never a stakeout. Almost always a document. A leak of company records from a formation agent. A whistleblower inside a bank's compliance department. A journalist consortium that spends 2 years reading files nobody was supposed to have. Or a client 3 levels away from you arrested for something unrelated who starts describing how his money got clean. And here is the structural problem you now have. You spent your whole career creating a paper record designed to look ordinary. It is enormous, it is meticulous, and it all still exists. The very thing that made you safe. A complete, consistent documentary trail is the thing that convicts you when somebody finally reads it in order. The charge, when it comes, is rarely the original crime. You may have had nothing to do with that. It is conspiracy to launder, or false accounting, or failure to disclose, or sanctions breach. Paper offenses proved with paper. That is the lesson of level 9. Every other participant destroyed their evidence as they went. Your evidence was the product. Level 10. What the top actually is. Here is what happened to the people who reached it. Some were convicted, and the sentences are frequently shorter than people expect. Laundering is prosecuted as a financial offense, and financial offenses are sentenced like financial offenses even when the underlying money came from something appalling. Some paid a settlement, admitted no wrongdoing, and kept practicing. Some lost their professional license, which for the accountants and solicitors was the real punishment because it removed the only thing they were selling. A number were never charged at all. They were named in a leak, described in a report, and then simply carried on, because being named is not the same as being prosecuted, and there is no offense of having appeared in a document. And the largest institutions paid their fines and are still open. You can bank with several of them today. So look back at the 34-year-old with a holdall under a bed. He thought the hard part was over. It had not started. Every level after that was a slow conversion of a criminal problem into a professional one. First into a business, then into a set of documents, then into a house, a salary, and a school run. And at each step, the people doing the actual work looked more respectable and were paid more. At the bottom, a man who cannot spend his own money. In the middle, a solicitor who does not ask a question he is required to ask. Near the top, a bank that files a report nobody reads. And at the very top, a fine paid by shareholders and a business that opens again on Monday. If this changed how you think about the phrase money laundering, share it. Subscribe if you are new here. Every week we take one structure apart from the bottom up and count out what it actually costs to climb.